Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Ken Leon, Director of Equity Research at CFRA, joins us now. Ken, what's your big takeaway from the earnings reports we've gotten so far?
I think the first quarter sets the base for growth for the rest of this year. And I think the narrative is to be conservative. We certainly have a different economic backdrop is for growth. We saw a very healthy loan activity that will accelerate for the rest of the year, not only consumer, but really business. And to your point about are the banks going to compete with the Apollos of the world? We saw healthy fixed income underwriting. We also saw off the shelf dusting bank loan syndicates and giving very aggressive pricing. So the direct lending from the Apollos and Ares is really bought off. So I think the opportunity here is really net interest income is based on rate, but also on volume. Volume is business activity, expanding the balance sheet. And that's why I think JPMorgan is guiding conservatively, and they're going to exceed expectations if we have a very healthy U.S. economy this year, which we believe.
Good morning, Ken. I'm looking at both Wells Fargo and JPMorgan on the provision for credit losses. And just before the break, as we went to the break, it said 1.88 billion at JPMorgan, less than $1 billion over at Wells Fargo. Still, both of these materially lower than the market had expected. And that talks to the uniqueness and the strength of the U.S. economy.
It does. And the narrative's different than January, where there was more concern of recession and also areas where we could see higher credit risk. So as to my point, as you see the volumes of a healthy U.S. economy, you will see some increases in loan provisions, but it's going to be proportional and it will stay in the normalized area. So I don't think credit risk is a problem, but both bank managements and analysts, we like to look at it and talk about it.
Well, obviously, dividend and buybacks are part of the narrative with banks. We'll hear a little bit more, hopefully, later on today from Jamie Dimon on that front. As you look at the banks, we've had this pivot to breadth in financials generally, but where's the leadership in the dividend story, Ken, for you?
It's a great question, and now we're speaking about investors in terms of when we look at the financial sector, 65% are 12 stocks. 6 of the largest banks are in there. And also return of capital comes up with the mid-year, the June bank stress tests. And we think the banks are very well capitalized. They're also building up their capital because we don't know what's going to happen with what's called Basel III Endgame, which is getting a lot of pushback from Congress that it's too onerous and has negative impact for the U.S. economy. So I think what we have here, and CFRA went to an overweight on the financial sector, and the large banks are part of that story, is because we're going to see very healthy return of capital. And probably we're going to get a glimpse of that at the end of June.
Ken, sometimes people take a look at bank earnings and they say it kicks off the rest of earnings season because it gives a tone of what the economic outlook looks like. I'm not clear on whether there is a clear read on the economy going forward in these earnings. Did you get one?
I think there is, because we did see credit service income still very healthy year over year and sequential. So the consumer is healthy in spending. We'll take a closer look at volumes or transaction activity. We did see in the commercial loan activity mid-teen growth year over year for JPMorgan. That suggests that we're seeing CEOs more confident for capital raising, whether it be through loan activity or going to the capital markets, which we think in the second half of this year there is a tsunami of capital that has to exit the private equity firms, which is going to benefit IPOs or M&A.
Meanwhile, what you're looking at in terms of net interest compression, that is compelling to me. And Menace was talking about this earlier, this idea that they've got to pay more for deposits and that deposits are leaving. This really raises a question. Is this basically you're going to get a more direct read-through of that 5% benchmark rate if you just get into a savings account? And this might be somewhat personal, but, there's this question of, are they going to have to pay up akin to what the regional banks have having had to do for a longer period of time?
Totally different businesses. It's an easy narrative. So I mean, if you're Citi or JPMorgan, you have treasury services, custodial, institution, and then of course you have small business and individuals. So their relationships are far greater than giving 5% versus, of a small bank versus 4.6% on a CD. Their relationships are dynamic. And when you look across where deposits are for these large banks, and there is a high percentage to my description that are non-interest bearing, that it's a little bit different. So Moynihan, the CEO of Bank of America, always has a great explanation for this, is we have diversified businesses. And in terms of our deposit base, it's also based on the underpinnings of other things that we do in those relationships.
Well, JPMorgan certainly has that breadth. Give me your view on this. If I reflect back to the start of the year, HSBC wholesale sacked 27% of the commercial real estate exposure. They were nervous. The world was nervous. We're less nervous now. It takes my mind back to just before the GFC. Who was left holding the baby when it came to, CDSs? Who is holding the baby in terms of C or E exposure that we should be concerned about? Or is that a media obsession and not an analyst's obsession with C or E?
We look very closely at that, and I also cover part of real estate, and there isn't a black swan event here for the largest banks. But when you go down and look at the total portfolio of commercial real estate, it's mostly in multifamily. And then when we go down to office, for JPMorgan, it's investment-grade borrowers, it's Class A tower buildings. It might be idiosyncratic, but to Gerard's point, Gerard Cassidy earlier, it's under 5%, 3% of the total loans. When you get down to the regional banks or smaller, it becomes more problematic. But because these are not massive consumer loans, they'll just kind of extend these loans for 2 or 3 years and work out any problem real estate. But for the largest banks, we all watch it very closely, and we look at all the metrics and think that this will be more idiosyncratic, not systemic.
Ken Leon of CFRA, you are going to be back with us in 8 a.m. following the Citigroup earnings. Thank you so much for being with us today. Neil Dutta joins us now with an answer to that question. Is this a pivot point this week, or is this something that just is more noise, more bumpiness to the same road to easing policy?
Well, I think the latter. I think it's a bumpiness on the path to still a couple of cuts this year. You kind of have to take the data as it comes to you, and certainly what we learned in the last week definitely throws a bit of cold water on the idea that residual seasonality was a big driver for why, we sort of missed the boat on inflation the first couple of months of the year, because March was still somewhat firmer. The PPI data certainly took some of the edge off in terms of what it means for PC, but at the end of the day, you're talking about core inflation, PCE inflation, likely to be running above 3% over the first 3 months of the year. So the way I'm thinking about it is, July at the earliest. We had 3 months of poor inflation data, and you're going to need at least that many months to undo the damage. So lots of things have to go right, but I think July at the earliest is probably the way I would think about it. And if you get another bad inflation number, you just push it out. I mean, Lisa, I do think it's worth reminding people that, you have to kind of go back to first principles in these sort of situations, right? I mean, we know the labor markets are cooling. We know that inflation expectations haven't really moved if you look at surveys of consumers and households. So at some level, that suggests to me that consumers are somewhat resistant now to taking on higher prices. And so if this continues, I'd be frankly more worried about corporate profit margins than anything else.
Well, Neil, this really raises a question about whether this sort of challenges a bullish thesis in equities more significantly than people are realizing. If you do see slowing under the surface, if you do see people pushing back on prices, the inability for companies to pass along things like oil prices and other commodities that are coming up, how much does that really make you less optimistic about what we get in the equity market?
Well, I mean, right now, the markets are kind of trading, right, at any given point in time, I think you could basically say, the economy is, one of four things, right? We could talk about soft landing, sort of, solid growth, benign inflation. We could talk about inflationary boom, or you could talk stagflation or a recession, right? Deflationary bust. And right now, I think the markets are kind of thinking inflationary boom-like dynamics. I mean, that's an environment where, stocks can work, bonds can't. If you kind of move towards a situation where inflation stays sticky, that begins to erode household incomes, it keeps the Fed off on the sidelines, then you're talking about a situation where equity markets will come under more pressure. I don't think we're there yet, but, certainly if we can, because I think inflation will cool. But if it doesn't, then you have to be cognizant of that risk.
And that's maybe what the bond markets, Neil, good morning, the bond markets have been trying to price. They did 30-odd basis points in the space of 2 weeks. We've gone a little bit back this morning. We've had a couple of auctions this week, which it took more to encourage people to buy the 10s and buy the 30s than it has for a long time. Now, that's because of market dislocation. But I'm looking at my inbox from Torsten Slok, and he says, we are seeing the first signs of U.S. financial stress appear. Trailing treasury auctions, rating agencies issuing opinions about deteriorating fiscal situation, and term premium trending higher. What do you make of that, the dislocation in the auctions this week? Idiosyncratic or something more malevolent?
I mean, I think it's, I think financial conditions have tightened. If you look across a range of different indicators, right, the dollar's going up, corporate credit spreads have tightened. I wouldn't say that it's a significant dislocation yet. I mean, I still think that, financial market conditions, have largely repriced because inflation has been higher. So, so in other words, inflation's higher. It's going to take a little bit weaker growth to get inflation back to where the Fed wants it. And so you're seeing financial conditions tighten. I don't think it's anything beyond that just yet.
Neil, we have some more news. We've been reporting all week that this attack potentially from Iran on Israel was going to be imminent, and we have reporting that it's going to be within the next 48 hours. We've seen a few signals from that, whether or not it's the U.S. directing embassy personnel in Israel where they should and should not go, France putting certain countries on no travel lists. Last time we spoke, you pretty much shrugged off geopolitics. At this point, how can you not say that this is not concerning at all to what is going on when you look at the global marketplace?
Well, you don't shrug it off. You take it as it comes to you, right? I mean, in my experience, like changing a fundamental forecast based on what's going on geopolitically is usually, by the time you start doing that, usually the crisis is over. That's in my experience. Now, what I will say, to me, the most interesting thing is just the relationship between what's going on in the energy markets and the dollar. Historically, everyone's thought, dollar down, oil up. But given the U.S. position as a major commodity exporter, and, we run a net surplus in petroleum, you're seeing, stronger oil prices boost the terms of trade of the U.S., and that strengthens the dollar, right? So the causality is actually from oil to the exchange rate in the U.S. I think it matters more, frankly, for emerging markets or, oil importers globally, because not only are they dealing with higher oil prices, they're also now dealing with weaker currencies. And that's going to limit the ability of those central banks to cut interest rates, which has been a reason for some of the enthusiasm in global risk appetite, right? So I think it introduces a little bit more tighter financial conditions, particularly in the rest of the world, I think, more so than the U.S.
Neil, before we let you go, it sounds like you're a little less bullish than you have been of late. Is that true?
Well, yeah, the data hasn't gone my way. How do you expect me to sound? You have to be honest with yourself, right? So, but I will just say, I do think ultimately, when the dust settles on 2024, we will still be talking about a situation where the U.S. economy is growing and the Fed will be cutting. That is, I think, still the fundamental story.
And honestly, Neil, the data hasn't gone anyone's way because no one's been able to game this out. Max, Neil, Dutta, thank you so much for being with us. Bank of America's Carey writing, quote, "We think the uncertainty overhang may challenge relative performance of the Russell 2000 for now, given higher for longer rate risks. Small is likely to lag large until later this year if and when we get more confidence in cuts." Carey joining us now. And Jill, this has been always a fascinating discussion. If we're getting this sort of cyclical boom, why are we not seeing it in the small caps? You're saying it's completely hinged on rate cuts, and if we don't get them, we're not going to get that rebound this year.
Yeah, and thanks for having me. I mean, we talked to a lot of investors, and I think there has been this year more optimism on small caps. We've seen that in the inflows that we track. But I think in all of the conversations that we have, investors have sort of been looking to the Fed as the next catalyst for why the Russell 2000 could move higher from here. Corporates in general, especially when you look at the S&P 500, they've locked in long-dated low-rate debt. But for smaller companies within the Russell, about 40% of their debt is either short-term or floating rate. So, we estimate this could be a pretty significant hit to earnings over the next 5 years if rates were to stay high relative to, if we see cuts, then this becomes a less detrimental headwind.
Jill, forgive me for sort of the hypothetical here, but what does it take to get some sort of fuel to this particular sector? Is it just one rate cut? Is it just taking the prospect for even higher rates off the table? Or do we need to sort of see the beginning of a protracted rate cutting cycle that could bring some of these interest expenses, back into something similar to the past?
Right. I mean, I think, one cut isn't necessarily just going to solve the problem. I think, given how elevated rates are, our economists are now expecting that we'll see a cut in December. They had pushed that back from June, and 4 cuts next year. So I think if we get greater confidence that we're on a path to lower interest rates, so that when these companies do have a lot of debt coming due over, 2025, 2026 and beyond, that refinancing won't be as big of an impact to earnings as it could be now if rates stayed at these levels. I think a lot of the macro positives for small caps still stand, the profits recovery. But, another risk there is that the profits recovery this year is very back-end loaded. Earnings are still going to be negative year over year this earnings season. Consensus is looking for small cap earnings to recover to about 30% year over year by the time we get to the fourth quarter. So we'll be paying a lot of attention to guidance this earnings season. So that could, potentially, if things do come through, set us up for a better year-end rally for small caps if we have confirmation that the back-end loaded earnings recovery is coming through, and if we have confirmation that, okay, inflation is cooling and the Fed is going to cut, which, as mentioned, is our economist's forecast now for December.
Jill, good morning. I'm looking at the breadth trade, and the Russell 2000 energy is at the top there, up over 10%, and tech. When you look at the commodity complex, we're talking about oil around this desk this morning, geopolitics with Anne-Marie, the warnings that are there. We're looking at oil, we're looking at copper, we're looking at some kind of a news cycle. Within the breadth narrative, within the Russell 2000, how do you play commodity strength, and will it endure?
Well, I think, the good news around the commodity-oriented sectors like energy and materials and industrials is that they are some of the sectors that have lower refinancing risk relative to sectors like real estate that could see a much bigger earnings hit. So I think within small caps, if you're an investor right now, you want to be selective, and some of these commodity-oriented sectors are one way to do that because they will benefit from higher commodity prices, manufacturing, GDP improvement, but they're less sensitive to refinancing risk. So that's one area that we see as relatively better positioned within SMID, and we'd stick with higher quality stocks and stocks that don't have a lot of leverage or short-term or floating rate debt.
And then I pivot 180 and I look at the lags in the Russell 2000, and it is in the financials. We're getting information through from JPM, from Wells Fargo, from Citi, and it is about the net interest income. And that story incrementally under a bit of pressure, but is that more pressure to come in financials in the regional banks?
So within banks, we'd favor large over mid banks for now. Obviously, the regionals have been challenged, and overall, this is a sector within the Russell that's sensitive to credit conditions and to the Fed. So that's an area that, even though it's ranked relatively well in our quant work, we're relatively cautious or more selective within right now. We'll see what all of the banks continue to say this earnings season, watching guidance pretty closely. U.S. corporates overall had guided relatively weakly in the last 3 months. Guidance usually is weaker at the start of the year, so we'll see if we see any improvement there. But in addition to financials, real estate is another one that we're more cautious on in small caps and does have more risk from refinancing.
Jill Carey Hall of Bank of America, thank you so much. As always, we try to parse through the different cost currents and the whack-a-mole of narratives.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.